273,000 active foreclosures are sitting in the pipeline right now, according to Intercontinental Exchange mortgage technology data released just days ago. That's up from 213,000 a year ago. Bank repossessions are surging 45% year over year. Everything we received in the last 60 days, from ATTOM Data Solutions, from the Mortgage Bankers Association, from the Federal Reserve itself, confirms that Phase 2 has shifted gears. Foreclosures hitting a 6-year high is just beginning. 3 things need to be understood. First, the specific FHA loan vintages where 65 to 70% of borrowers are already underwater, and which cities those are concentrated in. Second, why the auto loan delinquency rate just hit a level not seen since 2010, and what that means for housing. And third, what the Q1 home builder earnings reports just revealed, because Lender's executive chairman said one sentence on his March 12th conference call that captures the entire builder collapse. ATTOM Data Solutions released its Q1 2026 foreclosure report on April 16th. 118,727 properties had foreclosure filings in the first quarter alone, up 26% year over year, the 12th consecutive month of annual increases. Foreclosure starts hit 82,631, up 20% year over year. Bank repossessions, completed foreclosures where the lender actually takes the house back, came in at 14,020, up 45% year over year. The state level jumps are severe. Colorado completed bank repossessions went from 99 a year ago to 321 today. Alabama from 153 to 355. Florida from 487 to 1,014, more than doubling in a single year. Washington State went from 104 to 224. Oregon from 80 to 170. These are families losing their homes at multiples of last year's pace. At the metro level, Lakeland, Winter Haven, Florida has the worst foreclosure rate of any small metro in America, 1 in every 409 housing units. Punta Gorda and Columbia, South Carolina are right behind it. Indiana now has the highest foreclosure rate of any state at 1 in every 739 housing units, followed by South Carolina and Florida. Active foreclosure inventory stands at 273,000, the highest since February 2020. 60,000 more American families are in active foreclosure today than were a year ago. The FHA loan data is what nobody is showing you. According to IC Mortgage Technology's most recent mortgage monitor, in Cape Coral, Florida, nearly 70% of FHA loans originated in 2023 and 2024 are already underwater. In Austin, Texas, 65% of FHA loans from 2022 are underwater. In North Port Sarasota, 57% of 2023 vintage FHA loans are underwater. 8 metropolitan areas now have more than 1 in 20 of all homes in negative equity. Tampa at 5.4%. Colorado Springs at 5.6%. Jacksonville at 6.3%. San Antonio at 8.8%. Austin at 9.2%. Cape Coral at 10.1%. And Lakeland, Florida, the same city with the worst foreclosure rate in America, at 10.8% of all mortgages underwater. Nationally, the number of underwater borrowers is 1.1 million, up 15% year over year. Florida homeowners lost the most equity per borrower of any state last year, negative $29,400 on average. Here's what this looks like up close. A first-time buyer in Cape Coral purchased a $350,000 home in 2023 with an FHA loan. They put 3.5% down, $12,250, and financed $337,750 at 7%, with a monthly payment around $2,250 before taxes and insurance. Today, that home is worth about $305,000. They owe more than the home is worth. They can't sell without bringing cash to closing. They can't refinance. If they lose a job, get sick, get divorced, or get transferred, they go to foreclosure. That's not a hypothetical. That's happening right now to thousands of families across specific cities and specific loan vintages. while the rest of the country gets told everything is fine. Mortgage rates briefly broke below 6% on February 26, the first sub 6% reading in more than 3 years. The narrative for about 10 days was that spring would finally thaw this market. Then military operations began in Iran. Oil prices spiked. Gas hit $4 a gallon. Inflation expectations re-anchor higher. The 10-year Treasury yield ripped from below 4.1% to 4.35%, and mortgage rates blew back up. By April 2nd, Freddie Mac reported the 30-year average at 6.46%, a 48 basis point increase in 5 weeks. On a $400,000 mortgage, that's roughly $130 more per month. Rates have since pulled back to 6.23%, but the damage was done. Every spring buyer planning to lock at 5.99% got priced out. The Federal Reserve held rates steady at its March 18th meeting on an 11-1 vote. 7 of 19 Fed officials are now projecting zero-rate cuts for the rest of 2026. Jerome Powell acknowledged it plainly. Activity in the housing sector has remained weak. He also noted that after accounting for revisions, there have been effectively zero net job creation in the private sector over the past 6 months. We have a foreclosure crisis accelerating, an underwater problem concentrated in FHA vintages, a war that torts rate forecasts, and a Fed admitting the private sector has stopped creating jobs. This is not the setup for a housing recovery. Every major public home builder that reported Q1 2026, except luxury builder Toll Brothers, printed multi-hundred basis point year-over-year gross margin compression. Lennar reported March 12th. Gross margin 15.2%, down 350 basis points year-over-year. EPS down 56%, average selling price down 8% to $374,000. KB Home reported March 24th. Gross margin 15.3%, down 490 basis points. EPS down 65%, revenue down 23%, and cut guidance. Meritage Homes reported April 22nd. Gross margin 17.5%, down 450 basis points. EPS down 51%, cut guidance. D.R. Horton, the largest home builder in America, reported April 21st. Gross margin down 170 basis points. EPS down 20%, cut guidance, and confirmed Gulf Coast layoffs. Pulte Group reported April 23rd. Gross margin down 310 basis points. EPS dropped from $2.57 to $1.79. The Pulte CEO said Q2 will be the low point. Now here's the quote that captures everything. Stuart Miller, executive chairman of Lennar, on his March 12th earnings call. Normalized incentive levels run 4% to 6% compared to the 14% we're carrying today. Builder incentives are now more than triple historical norms. When you see a builder advertising a $50,000 incentive on a $400,000 home, that is not generosity, that's desperation. They're paying buyers to take inventory off their books because the alternative is worse. A John Burns Research Industry survey found that 63% of U.S. home builders said local peers had recently conducted layoffs, 87% in Texas, 79% in Florida. The home builder business model is structurally broken right now. They built massive inventory between 2020 and 2024, betting that low rates would return. They didn't. Builders are now paying buyers 14% incentives to clear that inventory. When those incentives end, prices will reset to whatever clears the market without the subsidy. The big public home builders are artificially propping up new home prices. When they stop, resale comparable sales will follow them down. If you're buying new construction in 2026, assume the home you're signing for is worth 10 to 14% less than the contract price the day you close. According to the New York Federal Reserve's quarterly report on household debt released February 10th, the 90-plus days serious delinquency rate on auto loans is now 5.2%. The peak during the 2010 financial crisis aftermath was 5.3%. We are within 0.1 percentage point of matching the worst auto loan delinquency rate in modern American history. Why does this matter for housing? because consumer credit stress doesn't stay in one bucket. When families can't make their car payment, they're already triaging their bills, paying a mortgage first because the family lives there, the car second because they need it to get to work. When 5.2% of auto borrowers can't make their payment after 90 days, mortgage stress isn't a question of whether, it's a question of how soon. Meanwhile, multifamily commercial mortgage-backed securities just hit an all-time high delinquency rate of 7.15% in March 2026. 80% of all new multifamily distress in March was concentrated in New York, New Jersey at 48% and Houston at 30%. These are mostly operating cash flow failures. Apartment landlords cannot make their loan payments out of rent collection. Office CMBS delinquency also hit an all-time high at 12.34% in January, bleeding into regional banks holding these loans on their balance sheets. Auto loans matching 2010. Multifamily and office CMBS at all-time highs. The foreclosure pipeline at a 6-year high, in which data set they're looking at. The Northeast and Midwest were the markets everyone called safe. The cracks have now started. The S&P Case-Shiller Index, released April 28 for February data, shows Denver has overtaken Tampa as the worst performing major market in the entire 20-city index. Denver at negative 2.18% year over year. Tampa at negative 2.06%. Seattle is now negative 2% with active listings up 42.5% year over year. The largest inventory increase of any of the 50 largest metros in America. Phoenix is at negative 1.78%. Dallas at negative 1.74%. The data point every Northeast homeowner needs to hear. Boston Metro median home prices just posted a 3.7% year-over-year decline, the first meaningful drop in nearly a decade. Sales are down 8.5% year-over-year. 60% of homes are now selling below list price, up from 50% the prior year. Active listings are up 15.3%. And the NAR's March existing home sales report showed Northeast region sales fall to 430,000 seasonally adjusted annual rate, the lowest reading on record in NAR's regional series going back to 1999, down 12.2% year over year. The Midwest region is at 920,000, matching the weakest pace since 2011. Hartford is still the hottest market in America by Realtor.com's measure. Chicago, New York, and Cleveland are still posting Case-Shiller gains. So the safe markets aren't all collapsing. But Boston is cracked, and the Northeast just printed its lowest sales month on record. The delay these markets enjoyed is ending. If you're a homeowner, the question isn't whether your home loses value tomorrow. It's whether your equity is being eroded right now and whether you're in a market where it's accelerating. There are currently about 600,000 more sellers than buyers nationwide. If you need to sell in 2026, price aggressively now. Every month you wait costs more because builder incentives running at 14% are pulling buyer demand away from resale, and those incentives aren't going down. They're going up. 6 Fed rate cuts didn't bring mortgage rates down meaningfully. A war just sent them back up. The foreclosure pipeline is at a 6-year high. Auto loans are approaching 2010 crisis levels. Builders are bleeding, and the private sector has stopped creating jobs. This is the slowest motion mortgage failure in modern American history. It's not a crash, it's a grind. And the grind just got worse.